Have you ever heard of PMI and wondered why you're paying extra every month on top of your mortgage? Or maybe you've been told you need it, but no one really explained what it is. Well, stick around, because in the next few minutes, we're breaking down the truth about private mortgage insurance. What it is, why it exists, how much it costs, and most importantly, how to avoid it. Let's start with the basics. PMI, or private mortgage insurance, is not for your protection. That might sound surprising, but it's true. PMI is designed to protect the lender, not you, the borrower. Here's how it works. When you buy a home and put down less than 20% of the purchase price, the lender sees you as a higher risk. So they require you to pay for insurance that covers their losses in case you default on the loan. Think about that for a second. You're the one paying for insurance, but it doesn't even protect you. It protects the bank. It's kind of like renting a car and having to pay for a damage waiver that only covers the rental company. It doesn't feel great. Now, let's talk numbers. How much does PMI actually cost? Well, that depends on a few things: your loan amount, your credit score, and the size of your down payment. Typically, PMI ranges from 0.3% to 1.5% of the original loan amount per year. So, if you borrow $300,000 and your PMI rate is 1%, you're paying an extra $3,000 per year, or $250 a month, until the PMI goes away. And that's an important point. PMI isn't necessarily forever. In most cases, once you've paid your mortgage down to 80% of your home's original value, you can ask your lender to cancel PMI. And if you don't ask, it usually gets canceled automatically once you reach 78%. But that doesn't mean you should just wait it out. If your home has appreciated in value or you've made extra payments, you might be able to cancel PMI sooner, saving you hundreds or even thousands of dollars. Now, here's where it gets interesting. There are different types of PMI, and the one you end up with can affect your bottom line. The most common is borrower-paid PMI, which shows up as a monthly fee on your mortgage bill. But there's also lender-paid PMI, where the lender covers the cost, but they usually charge you a higher interest rate in return. Then there's single premium PMI, where you pay it all up front at closing. That could save you money in the long run, but only if you plan to stay in the home long enough to make it worthwhile. Let me tell you about Sarah. She was a first-time homebuyer who couldn't quite afford a 20% down payment. Her lender added monthly PMI to her bill, costing her an extra $200 each month. But Sarah made extra principal payments and refinanced after 2 years, removing the PMI entirely. In total, she saved over $7,000 in PMI payments she would have otherwise paid over the life of her loan. Now, if you're wondering how to avoid PMI altogether, here are a few strategies. First, the obvious one. Put down at least 20%. Easier said than done, I know. But if you have savings or help from family, it's worth considering. Second, look into piggyback loans. This is where you take out a second loan to cover part of your down payment. For example, an October 10th, 80 loan means you get an 80% first mortgage, a 10% second loan, and you contribute 10% in cash. That way, the main lender sees you as putting 20% down, and PMI isn't required. Another route is using government-backed loans like VA loans, which don't require PMI at all, even with no down payment. If you're a veteran or active duty service member, this is a huge benefit. FHA loans, on the other hand, do require a form of mortgage insurance, but the structure and cancellation rules are different. And here's something many people overlook: negotiating with the lender. If you have excellent credit, some lenders might waive PMI or offer reduced rates. It never hurts to ask. Also, make sure to get an updated appraisal if your property value has increased. You might qualify to cancel PMI sooner than you think. especially in a hot market where home prices are climbing fast. So, what's the bottom line? PMI is one of those costs that feels like a penalty, but it's also a tool that helps people become homeowners sooner. Without it, many folks would be stuck renting for years trying to save that 20% down. But just because it's common doesn't mean you should accept it blindly. Understand what you're paying, explore your options, and make a plan to eliminate it as soon as possible. If this video helped clarify things for you, hit that like button. It really helps the channel. And if you've dealt with PMI, share your story in the comments. Were you able to cancel it? Did you find a creative way around it? Let's help each other out. And don't forget to subscribe for more clear, honest breakdowns on home buying, loans, and personal finance. Thanks for watching, and I'll see you in the next one.